Hi, we're Group One, and we'll be talking about Uber and Lyft. Starting with the business analysis. The current rideshare market industry has Uber leading at $154.24 billion, Chinese-based Didi with $23.72 billion, Singaporean-based Grab Holdings at $16.12 billion, followed by Lyft at $5.52 billion. The global market share for the rideshare industry was reported to be 106.66 billion in 2023 and is expected to grow to 408 billion by 2032. Why has the global market for rideshare increased? Due to the convenience of calling a ride from anywhere and being picked up quickly, the cost benefits of rideshare compared to taxi, and the technology of using a smartphone app to track your drivers and routes. Industry challenges. Key challenges that the rideshare market face are autonomous vehicles, changing in the economic conditions, regulatory changes, and driver retention. Autonomous cars are becoming increasingly popular in the rideshare market and may have an effect on the profitability of Uber and Lyft in the future. Economic conditions such as the COVID pandemic or a recession can greatly diminish the number of Uber and Lyft riders. Both companies saw a decline in ridership of up to 75% during the pandemic. Government regulations such as rideshare limitations, which we're seeing in New York, can challenge the profitability of Uber and Lyft in specific regions. Currently, Uber and Lyft are using lockouts in New York City to avoid paying the base minimum pay instituted by Mayor Adams. Rideshare companies also need to deal with retaining drivers, as ride sharing is not profitable but enough to become a career and is more of a bridge job for drivers. The timeline for Uber starts when Uber was launched in 2009 as the first rideshare company, which would deliver would you would be able to request rides from your phone and be delivered to your destination. In 2011, Uber launched Uber Pool, allowing multiple riders to split the price of an Uber if they were traveling in the same direction. In 2014, Uber received 1.2 billion in investments in their Series D round. In 2015, Uber went international by launching in Paris, France, and established itself as a multinational corporation. In 2015, Uber launched Uber Eats, a way for customers to order food and have Uber Eats deliver it to their door. The popularity of Uber Eats is a big reason why Uber has separated themselves from other rideshare companies. In 2018, Uber reached the milestone of 10 billion rides through 5 continents and 173 countries. The global presence of Uber is unmatched and is the largest rideshare company operating in the most countries. The timeline of Lyft begins when Logan Green created a rideshare company called Zemride, which was designed as a carpool service for students to ride long distances together to and from college campuses. In 2012, Lyft launches in San Francisco as a subsidiary of Zemride. Lyft is focused on short commute rides rather than long distance travels of Zemride. In 2013, Zemride got renamed to Lyft, and they were able to raise 60 million in their third investing round. Later in 2013, Rakuten invested 530 million into Lyft, giving it a valuation of 2.5 billion at the time. In 2015, Lyft partnered with competitor Didi to allow Lyft users to use their app in China, which would call Didi drivers, and vice versa for Didi users in America. This partnership wouldn't last long, as in 2016, Didi would purchase Uber China and leave their agreements with Lyft. In 2019, Lyft went public on the NASDAQ exchange for $87 a share, which was a massive success for the company at the time.
Uber's business is divided into three segments: mobility, encompassing Uber's rideshare, carshare, and micromobility offerings; delivery, which we all know as Uber Eats; and freight, a B2B service connecting carriers and shippers. Mobility makes up the greatest share of its earnings. Lyft officially operates as a single segment, but has a few different revenue channels: its primary rideshare services, micromobility, recently dubbed Lyft Urban Solutions, and ads business called Lyft Media.
Looking at Wall Street positions and expectations, here is a quick comparison between the Uber versus Lyft stock performance over past 5 years. As Uber now moving to profitable business, that is showing up on its stock performance, whereas Lyft, because of its challenge, it has long way to catch up with Uber. Next, for Uber, Investors are bullish based on diversified and aggressive business models and has buy rating along with its growth opportunities in India and Latin America. Top challenges for its growth being regulatory challenges and innovation adoption like autonomous vehicle technology. Next, now, looking at left investor takes, Wall Street is cautiously looking for now on left business. Stock is underperforming because of its unprofitability and undiversified business. Although left has potential for operational efficiency and could benefit from increased adoption of micro mobility solutions, example, scooter, bikes.
Now we will look at the business risks. There are many considerations listed under Uber and Lyft business risk factors. For the sake of time, I have consolidated them to the most important and prevalent factors. Uber's business would be adversely affected if drivers were classified as employees instead of independent contractors. This would change their income and tax associations and legal liabilities and therefore affect income. Other risk factors are if Uber is unable to attract or maintain a critical mass of drivers, if Uber is unable to optimize their organizational structure or effectively manage their growth. Another risk is Uber generates a significant percentage of gross bookings from trips in large metropolitan areas that can be significantly affected by macroeconomic, weather, and public health conditions like COVID-19. There is a risk as a result of competitor innovation and/or pricing. Uber's platform could become less appealing to platform users. There's also risk if AV technologies may fail to launch, fail to perform as expected, or may be perceived as inferior to and/or less safe than those offered by competitors or non-autonomous vehicles. Uber has experienced and may experience security and data privacy breaches, and inappropriate activity on the platform that results in major safety incidents could have an adverse impact on Uber's reputation. Regulations may block or limit Uber's ability to provide their offerings in certain jurisdictions, particularly regulations related to competition and financial services that could adversely affect Uber's business, financial condition, or operating results. Uber also faces risks related to data processing, which could result in investigations, litigations, fines, regulatory action, and negative press about privacy and data protection practices. Uber is also exposed to market risk for changes in interest rates related to their debt. Uber faces investment risks related to their investments. And finally, Uber has foreign currency risks because it conducts business globally in multiple currencies. Next slide. Lyft notes the following risks: the ability to attract and retain drivers and riders in a cost-effective manner, effectively pricing their services, complying with existing and new business regulations, managing their platform, assets, and expenses in light of economic and other developments, including changes in rider behavior and demand, planning for and managing capital expenditures for current and future offerings, maintaining their brand reputation, successfully expanding their geographic reach and manage their international operations, successfully developing new offerings, right-sizing their real estate portfolio, fluctuations in interest rates related to their long-term debt of $865.2 million, and finally, investment risk related to their short-term investments of approximately $1.7 billion.
Now, taking a quick overlook at executive compensation, Uber CEO has total compensation of $24.3 million, aligning with their vision and goals. Higher compensation tied to the aggressive global growth and profitability goals, also aligning with their global dominance and diversification. Where in the next slide, whereas looking at the left compensation, left executive compensation of executives has a compensation of $7.3 million. This lower base and equity heavy structure supports its leaner strategy, reflecting its US business recovery and market specific focus. Next.
Starting with the vertical components for each accounting periods, let's take a look at a common size analysis for both companies using percent of total assets, liability, shareholders' equity, and revenue as the respective base figures, while focusing on the major differences in the line items from the consolidated balance sheets and statement of ops. Compared to Lyft's ratio of current to non-current assets, we can see that Uber has a higher proportion of non-current to current assets at 7 to 30%, which indicates Uber is more equipped for long-term operational growth and set up for a stronger market position down the line. This is reflected in the investments into autonomous vehicles and the operational infrastructure for its additional freight and delivery sectors. Uber's significantly higher amount of goodwill illustrates they are investing in acquisitions that will produce future value. We can see that Lyft has a much higher percentage of short-term investments, which could indicate they're more liquid and potentially more flexible for unanticipated circumstances. However, Lyft has almost double the percentage of current liabilities compared to Uber, and thus indicates they are more focused on meeting short-term debts and other short-term obligations. The increased amount of current liabilities shows Lyft has a greater need to create cash flows to meet these short-term obligations. Uber has much more long-term debt, which indicates the company's focus toward long-term financing to support its future growth trajectories. Overall, Uber has a more balanced distribution of assets and liabilities, positioning the company for long-term upward mobility, where Lyft is more focused on liquidity and managing short-term investments to continue operations. Next slide. Despite having much more additional paid-in capital compared to Uber, Lyft has a significantly increased accumulated deficit, which supports why they haven't been able to be profitable yet. This could be from their business model, primarily focusing on rideshare compared to Uber's diversification into other sectors. Lyft's reduced pricing business model and effort to stay competitive with Uber may also be attributing to this. Overall, it seems that Lyft is struggling to bolster their brand recognition and brand equity. Both companies have a relatively high cost of revenue. Uber's is slightly more, which is supported by the delivery operations from its other two major sectors. It should be noted that Lyft has much higher total costs, expenses, and losses from its operations. That being said, Lyft has made significant decreases in R&D, G&A, and sales and marketing expenses over the accounting periods. Nonetheless, these charts indicate Uber's increased capital efficiency and utilization compared to Lyft, and Uber's increased efficiency to revenue conversion. Lyft seems to be reliant on the financing to fuel its operations and thus may require further restructuring and diversification in order to turn the tables. Next slide. Now let's take a look at the horizontal analysis to identify growth trends and predict future changes for both companies. Briefly touching on the assets, we can see changes in composition of current and long-term assets have been relatively stable between both companies. What's most important here is that the difference in ratios illustrates the different operational structures of both companies and the scale. Next slide. Starting with revenue, we can see a much larger growth trajectory with Uber at 17% compared to Lyft at 7.5% between the accounting periods. In fact, Uber's revenue growth is eclipsing their cost of revenue by about 3%. Lyft saw a 7% increase in revenue and a similar ratio of revenue to revenue costs. But if we look closer at the operating expenses, we can see major differences between the companies. Lyft's operating expenses decreased by a margin of 25%, indicating drastic cost-cutting measures, while Uber was around 2%, indicating stronger operational leverage and thus a higher potential for growth. Cost-cutting measures may actually hinder Lyft's growth potential. So Uber's 120% growth in net income is quite significant. In 2023, marked the first time the company was profitable. Lyft also showed improvement with reduced losses by around 67%, but still has a way to go to achieve profitability. Uber strengthened their current ratio by about 14%, achieving a ratio well above 1, signaling heightened short-term liquidity. Lyft also increased their current ratio by only about 6% and still is below 1. Lyft's increased current liabilities to assets indicates potential short-term liquidity issues, and they might not be able to cover their short-term debts. Looking at long-term debt to equity ratios, we can see both companies showed improvements with Uber at 31% and Lyft at 25%. However, Uber being 0.85 presents much less of a financial risk to lenders and investors and indicates the company has been more successful at deleveraging. Overall, both companies are ameliorating their financial stability, but it's clear the rate of change between the companies is diverging in the favor of Uber. Both Uber and Lyft had relatively strong improvements in gross profit margins at 3% and 4% respectively. The increased gross profit margins for Lyft may reflect their cost reduction efforts. If we also consider the change in return of assets, the differences, though, are more apparent. Uber showed an 83% increase in 2023, which aligns with their profitability benchmark. They're clearly reaping increased value from their assets and demonstrating increased operational efficiency and leverage. Lyft also demonstrated significant improvement by around 67.5%, but it should be noted that their ROA is still negative, indicating heightened financial risk. This could be reflecting the company's inability to meet their short-term debts or decreased operational efficiency, or both. Despite the similar gross margins, Lyft is not generating bottom-line returns with their assets. We believe this indicates Lyft is much more reliant on short-term financing to fund their daily operations compared to Uber. It should be noted that Uber is a much larger company and has a different asset structure, so they might be benefiting from scale economics in this comparison. Overall, it's clear that Lyft is still experiencing financial distress despite significant improvements from 2022.
Taking a closer look at changes in assets, we see that while Uber has a significant hit to its assets in 2022, which was largely due to reevaluation of their equity investments in other companies, Uber's asset growth rate in 2023 far exceeded Lyft's, driven by significant growth in Uber's current assets that year. Lyft's short-term investments decreased over both 2022 and 23, as did cash in 2022. However, as Lyft's revenue grew more than its costs of revenue in 2023, Lyft saw a 98% increase in cash, bumping its total assets towards a hair of positive growth. Turning next to earnings calls. In Uber's last earnings call, Uber reported a record quarter with profitable growth, gross bookings up 20% year-on-year, with an all-time high GAAP operating profit of over $1 billion. Uber's ad business grew nearly 80% year-on-year. Uber One members who pay a subscription fee in exchange for savings benefits increased by 70% year-on-year, reaching over 25 million. Uber is working with 14 AV partners and is piloting AVs in a handful of cities. Uber expects significant increase in commercial insurance costs going forward, and noted that their mobility bookings decelerated by 3 percentage points. Next, in Lyft's most recent earnings call, it highlighted its focus on product innovation, partnerships, and efficiencies on a per-ride basis. They saw an all-time high in active riders and driver hours, with double-digit growth in both rideshare and micromobility modes, with 16% year-on-year increase in gross bookings, exceeding 4.1 billion. Lyft is seeking to differentiate itself with reliable pricing, reducing primetime surge pricing, and offering price lock subscriptions. This attracts riders, but also decreases per-ride margins. Lyft is expanding in Canada. They touted that drivers prefer Lyft to Uber. Pursuing media partnerships, Lyft Media ad revenue grew nearly 3 times year over year. Lyft flagged that their insurance renewal costs are expected to increase. Lyft envisions using both AVs and human drivers in the future, but we're unable to answer investor questions as to when a rider might prefer an AV to human driver. Next, we'll look at key ratios. Next, we see here that Lyft has a lower return on sales than Uber. Both Uber and Lyft lost money per each dollar sale until 2023, when Lyft's loss per dollar sale lessened to 8 cents and Uber saw 5 cents profit per dollar sale. These indicators show Uber's relative strength when it comes to generating profit and controlling expenses. Next, we see Lyft's current ratio and quick ratio declining over the last 3 years, while Uber's has increased. At the end of 2023, Uber had $1.19 in current assets to cover each dollar of current liabilities, while Lyft had only 87 cents in current assets available to cover each dollar in liabilities, or just 57% if we look at quickly available assets. Next, a debt-to-equity ratio of 1 to 2 is often considered acceptable for a tech company. Uber's debt-to-equity ratio is fairly in line with this industry standard, while Lyft exceeds it significantly. If we look at just long-term debt-to-equity ratios, both companies' ratio decreases, as we saw those numbers on the previous slide, but Lyft still carries more debt per dollar of equity than Uber. Next. Over the past 2 years, both companies are improving how efficiently they are using its owners' money to generate profit, as indicated by these return on equity numbers, but Uber is outperforming Lyft in value produced per share. Lyft's significant borrowing deepens the negative value of its ROE. Next up, we have earnings and loss per share. In 2022, there was a loss of $4.64 for each share of Uber common stock, but in 2023, Uber earned 93 cents per share. Over the last 2 years, Lyft decreased its loss per share from $4.47 to 88 cents. Overall, these key ratios depict that Uber is in a stronger position relative to Lyft. Uber has been better able to generate profit and has more assets to meet its liabilities. Uber's price-to-earnings ratio, based on Uber's stock price on December 3rd of this year, is 76.6, indicating that either their stock might be overvalued or that the market perceives large growth potential for the company. Based on our overall analysis, we would agree with the latter.
In conclusion, as discussed and analyzed in previous slides, based on each company financial strength, focus, profitability, and leverage capacity, we select Uber as investing and lending candidate. Next, Here are our quick recommendations on investing and lending in Uber. Hypothetically, we decide to invest $500,000 in Uber for 1 year with a trajectory of 30% ROI driven by Wall Street's bullish outlook and market leadership. And also, we would lend about $1 million to Uber for 3 years at an 8% interest, yielding a 24% ROI due to the strong financial stability. Therefore, Uber is a clear choice of maximizing returns with manageable risk. Thank you.